Hi, it's Adrian Sims from LearnCIMA.com. The E3 syllabus is about business strategy, but it is a management accounting examination. And at some point, CIMA requires you to know what is the role of the management accountant in business strategy. Now, some of that is providing information to the process of strategy formulation, but one very important topic is the topic of strategic control. And that's the topic of this video. Control takes place in an organisation at 3 levels, and these levels are identified by R.M. Anthony. The operational control level of the organisation is at the factory or process level. It's short-term control of the day-to-day and week-to-week operations of a business. Operational controls are overseen by management controls or managerial controls, and these are the controls that operate at divisional level. And typically things like the annual budget is an element of managerial control. But in the E3 paper, we've been looking at strategic decision making, and that means there must be strategic control, an overview and the long-term development of the company, frequently from the corporate level of the organisation. Now, as you can see, Anthony was writing in 1964, the era of the top-down, rational planning approach to strategy. As we'll see as we talk through, the development of strategic management, the idea that divisions should have more responsibility in strategy, starts to change the notions of where strategic control might want to take place, where strategic control might need to take place. What's the distinction between operational control and managerial control? Well, operational control is control over established operations. In operational control, people are not free to change what the company is trying to do or how it does it. And it works in relatively short time frames. Whereas managerial control has more discretion given to the controller. They can make decisions on what the target should be, whereas operational control is simply following the targets that they've been given. And managerial control brings with it responsibility. If I can change what the company does and I set targets and I can change processes, then I have to be responsible for what then takes place. And hence in accountancy we talk about responsibility accounting. Now, management accounting control operates within a control context or control environment. And there's other ways that organisations are controlled. For example, operational control is oftentimes done by direct supervision. The boss can see what you're doing. If you do it wrong, he calls you out about it or she calls you out about it. There are planning processes, not just for money, but planning to meet customers' demands, planning for training, and all the various functions that make a business up. There are also going to be targets based on key performance indicators, and of course that's where management accounting tends to be involved. But remember that marketing and HR and IT will also have targets based upon key performance indicators. There may be internal market processes where divisions of the company buy and sell from each other as if it's a market, and each division is required to make a rate of profit. That makes it concern itself with efficiency and meeting its customer needs. Some organisations depend upon their culture as a control. For example, in a health organisation, I'd rather not go for an operation with a doctor if I thought the only reason he was doing it was because of some KPI. I'd rather hope his professional ethics and the culture of the business will make sure that I get seen to properly. And lastly, the individual person's own self-control. That is, that people want to make sure they do their best job. And one way of making self-control work, of course, is to have performance-related pay, where a person finds the best way of making the sale or the product so they can get their bonus. Now, the control system will vary according to the organisation that it's being applied to. And at the E3 level, you can be asked questions about organisational structures and configurations, because that will lead to a change in the control approach being used. Now, you saw these in the E1 paper of CIMA, first of all. The original organisation has an entrepreneurial structure, where the person that founds the business takes all the management decisions. As the organisation starts to grow, that entrepreneur finds overload a problem. And so they start factoring out parts of their job. They might appoint a salesperson, or maybe they appoint someone to look after the factory. Well, these are the embryonic sales department and operations department. So as the organisation starts to grow, well, then we're going to find an operations director and a sales director will start to emerge alongside the HR director, finance director, and so forth. So a functional structure is where the various factors of management have been broken out into specialist departments. Next up, the organisation starts to diversify, and that diversification could be different kind of markets it might move into. It may acquire different industries or go to different countries. In that point, organisations adopt a divisionalised structure where it makes more sense for the operating division in a certain country to run its own affairs separately from the rest of the group. They become divisions of a group. That always leads to problems of coordination. So therefore, many organisations will try to overwrite the divisional structure or functional structure with some kind of joined upness, and that's called the matrix structure, when somebody is responsible for a particular customer and they represent that customer to the various functions and divisions of the company. Or possibly a project manager has to make something work across all divisions of the company and therefore is assigned some responsibility for that outside the main structure of the firm. Another organisational characteristic is at what level in the organisation is control taking place and at what level in the organisation are decisions being taken. And that can lead to the concept of centralisation, when decisions are reserved for top management, and decentralisation, where they're allowed to divisional and lower levels of management. And of course, strategic management approaches that are bottom-up are ones that are more decentralised than strategic management approaches that are top-down because they are centralised. Now, the diagram you see here is a simple form of functional organisation. It's a unitary organisation, sometimes called a U-form organisation. As you can see, it's only in one place and only doing one thing, and the breakup of staff is into simple departments, as you can see, marketing, sales, and so on. The control situation in that kind of firm is relatively simple. CIMA is rather more interested in a more complex form called an M form or multi-divisional form organisation. And here you see you've got a group of businesses within businesses, and each business division has its own finance and production departments. So let's look at how one would control a business like that, a multi-divisional business with factories and plants and offices in different locations doing different things. Divisional performance evaluation needs us to understand what does control mean. And control is basically making sure the right things happen. Now, one way of putting this is the phrase, what gets measured is what gets done. If we set performance measures for people, for managers, then they're going to ensure that they reach those measures because they'll be judged upon that. Their bonuses might depend upon it. Their careers could end if they didn't do these things. And that's an important point. We may set targets and goals for divisions, but in reality what we're doing is we're setting controls and targets for the managers of those divisions. And these managers have got mortgages and they've got lifestyles to keep up. And so they're going to feel that these targets are simply ways to make them do what the company wants them to do. But they're also going to be very fearful if they feel those targets are going to be difficult to reach. And for that reason, a lot of management accountants have talked about the characteristics of appropriate divisional performance measures. And one such academic is Mahmoud Ezamel, and he refers to the 3 goals of divisional performance measures: autonomy, controllability, and goal congruence. Divisional measures, says Ezamel, must allow autonomy to a division. If we don't give autonomy to the divisional manager to make decisions, then it's not truly a division. The whole point of having separate business divisions is to give more flexibility. So controls must not be too tight. They must allow autonomy, but they must also allow controllability. Now, controllability has got 2 aspects. First, there's an ethical aspect, that it's not fair to make a target for a manager something they can't actually control. So if you say to a manager, you're responsible for the profitability of your business, but the volume you can make, the price you sell it at, the cost you make it for, and indeed the assets you use are all determined by head office, then he's going to feel that there's nothing he or she can really control at all. So it's very important that costs and revenues that are being the subject of the target are within the manager's control. There's a second aspect to controllability, and this comes with things like head office overhead. If we apportion head office overhead to divisions, those overheads are not controllable by the division and they're resented. But also, if we've got a lot of head office costs rising and all we do is we make them the responsibility of people who can't control them, well then the head office overheads are not controlled by anybody. and they can rise and rise and rise, and they're not within the control of anybody at all because the people who are causing them are not responsible for them. The third element is goal congruence. We do want divisions to have autonomy, but we want them to use that autonomy in a way that actually serves the purpose of the group. We don't want the corporation to be like a spoiled family all quarrelling with each other. We want them to work harmoniously. So targets must have goal congruence and contribute to the overall mission and strategy of the business. Andy Neely referred to the reasons for performance measurement, and he called it the 4 Ps. And it's a good way of remembering what does performance measurement do inside a business. Of course, the first 2 we might think are fairly obvious. It is a way of checking the position of business. So management have performance measures so they can check that profits and cash flows and sales are where they need to be. And secondly, they can communicate the position. They are summary measures that can be given to the board in a report, a month-end document or something, which enables them to see. But they have got a behavioural pair of goals as well. They can confirm priorities. Remember, what gets measured is what gets done. If management decide to set targets and goals to achieve this and that and the other, then that must mean management want those things doing. They confirm the priorities. And finally, because people's careers and pay and bonuses are based on measures, they compel progress. Because a manager that does not reach their targets is the one that doesn't keep their job very long. So control measures have got a technical purpose of communicating the position and checking the position, and a behavioural purpose of confirming what is important to the business and compelling managers to reach it. Okay, so we're moving on now to look at some of the more popular methods of control and a bit of a history lesson, because control wasn't invented centuries ago. The first management accounting controls appeared in the very early 20th century, and they're associated with a manufacturing company in America called DuPont. And DuPont made chemicals like explosives and paints. And they invented one of the most famous divisional performance measures, return on investment, or sometimes called return on capital employed. This is because DuPont was a manufacturing company, and the people that owned it had borrowed money from the bank to purchase the shares from the rest of the family. It was a family-controlled business. And so they were interested in whether or not the profits that the company was making was actually sufficient to pay the interest on the debt. And so therefore, they simply required that all divisions made enough profit to give sufficient money to pay the interest on the debt that had been used to buy the assets in that particular division. So return, profit, over investment. Almost like a rate of interest on the business unit. This became very popular and is still used widely today. And the reasons for its popularity are because it's a very interesting summary measure. It's very easy to see it. It's also possible to derive a series of sub-measures from it. For example, the return on capital employed is therefore determined by such things as the gross margin, the net margin, the asset turnover ratio, and therefore a group of other ratios can be generated that will lead to a return on capital employed. There's a pyramid, if you like, of different ratios that lead up to the key goal of return on capital employed. It's also a percentage which is very easy to understand. People put money into a bank account and get a good percentage rate of return, they know they're doing well. A low percentage rate of return, they're doing badly. But the problem is that from an economic point of view, a percentage return is neither good or bad. You have to compare it with something. And what DuPont was saying was, we are paying a certain rate of interest upon our debt, and therefore we must have divisions that create at least that percentage rate of return so we can pay our debts. Therefore, in modern financial strategy, we talk about a cost of capital, a minimum rate of return necessary to satisfy investors. And we should be saying divisions are doing okay, providing they actually achieve that minimum rate of return, the cost of capital, or better still exceed it. But the problem is that many managers see the percentage rate of return of their division as a badge of pride, and they look to try to maximise the percentage rate of return upon capital and not just simply make it adequate. And that can lead to dysfunctional decisions. Over-investing in projects that may not be very profitable, but can simply boost their return on capital employed, or under-investing in what would be a profitable project, but is going to give a rather low return on capital employed. This is not just a theoretical problem, it became practical. So in the 1950s, the American corporation General Electric developed another measure of performance called residual income. And the formula for this one is the operating profit of the division minus the opportunity cost of the capital assets the division uses. And the opportunity cost of the capital assets of the division are the capital employed in the division times its cost of capital. And providing the residual income is zero or positive, then the division is making at least as good a return on its assets as the same assets could be used for in their best alternative form of occupation. But residual income, despite being theoretically superior to ROI, does tend to fail because it's complicated. People don't naturally think in terms of residual income, they think in terms of rates of interest. And of course, it's not an easy summary measure. For example, a firm with a large number of assets might have a higher residual income than a division with a small number of assets. And so therefore, is a high RI better than a low RI? Well, it rather depends on the asset base. So managers don't find it particularly clear. Both of these are financial measures of divisional performance, and therefore they both have the same problems. Now they're both measures of managerial performance. In other words, the performance of divisions. They're not strategic measures. They are short-termist. They're going to utilise figures like profit, and profit is only ever measured at maximum over a year. So a 5-year strategy cannot be communicated using a 1-year measure of performance. They're not strategic. They don't incorporate future earnings. So an investment in something that won't make any money this year won't be undertaken if the manager has been given a performance measure based on profit. We tend to evaluate strategic decisions based on net present value of future earnings, but ROI and RI don't have a concept of net present value. They will also discourage investment because we know that if new capital assets are purchased, then their book value will be very high. That will give a low return on investment, will give a low residual income. As the assets get older, they depreciate, and therefore they have a lower book value, so gradually, as if by magic, the ROI will start to increase. And yet, strategic development of a business requires investment in new assets, not milking profit out of old assets. And finally, it's been suggested they've been distorted by accounting conventions, because what we count as an asset depends upon what financial regulations allow us to put upon the balance sheet or statement of financial position of the company. So things like investment in intangibles like training and branding, well, they're not counted within the performance measure. From a strategic point of view, other problems of financial performance evaluation measures come from the fact that they are results and not determinants. We are trying to use these performance measures to check our position, to be able to compel progress. But a financial measure is only recorded at the end of the year and is the consequence of good marketing, good branding, good customer service, innovative R&D. Now, we need to measure the causes of competitive success. So profit can go down because of a problem, but by the time the profit figure has gone down, the problem, whatever it is, lack of customer service, lack of sales, gone on too long, perhaps, to be something we can fix. So things like innovation, quality and flexibility, the important drivers of competitive success, are not measured quickly and in a timely way by a profit figure. Of course, profit is also a financial outcome of a business. Modern businesses are concerned with things like corporate social responsibility. They also want divisions to operate synergistically to be able to pursue the company's mission. And it's very hard to communicate those things with purely financial measures. The work of Gould and Campbell drew this to people's attention. Gould and Campbell in the 1980s looked at major corporations and how the corporate centre, or as they called it, the corporate parent, actually managed to influence the behaviour of managers. So how did strategic control work in a business, and how did it inform managerial control? They looked at a number of different industries, and they identified what they called 3 broad styles by which the corporate centre would influence divisions. A strategic planning style was the one that you'd associate with the rational model. The idea that divisions are fundamentally controlled by the use of strategic plans, and that performance measures are really quite secondary in determining what divisions do. At the other end of the spectrum is the financial control style, and these were styles that they saw happening in large conglomerate organisations, particularly mature manufacturing businesses like DuPont. And here, all the corporate parent did was it acted like a super shareholder, saying, are you making enough return on the assets you have? They were not concerned with the long-term development of the business, and they were not concerned with how the divisions work with each other. But what interested Gould and Campbell was the third control style, which they called strategic control. Now, if you notice, strategic control is made up of some words from the other two styles. It's got some of the strategic planning style in it, but it operates on the basis of performance measures and control from the financial control approach. And they found strategic control to be a combination of financial and non-financial performance measures designed to steer and mould divisions to behave in a corporately synergistic way. Gould and Campbell's research didn't achieve worldwide recognition, whereas the next model, which is very much a strategic control model, did achieve worldwide success, the balanced scorecard of Kaplan and Norton. Now, the main writer of this was Professor Robert Kaplan, and Kaplan had been someone for many years who had been saying that strategic management accounting needed to develop new performance measures to help businesses become more successful. Indeed, he blamed many of the problems of American industry upon what he called accounting lag, the tendency of management accounting measures to lag behind what the competitive strategy of a business needed. And he was given the opportunity to look at the performance measures of some high-performing American businesses. And these were largely in the area of information technology. And he took a team to look at the performance measurement systems of the divisions of high-tech companies. And he reflected upon these and said that these successful businesses seem to measure their performance under 4 different dimensions or different criteria. They have a financial objective, and they measure their financial performance, but they also measure the way in which they approach their market, and he called that a customer perspective. He also noted those organisations delivered financial performance and customer performance through attention to 2 other sorts of processes. Their internal business processes, and there were measures for those, but also their ability to innovate, or what he called learning and growth. And that gave the idea of a balanced scorecard of measures, that businesses would have a vision and strategy that comes from its strategic management approach. And these would be delegated to divisions, and divisions would be required to create a financial set of objectives and goals and report upon those to corporate centre, but also an outward-looking set of customer goals and objectives, the ways they're going to make that money, and then underlying those business process objectives, which are both efficiency, affecting costs and revenues, but also effectiveness, affecting the customer, and learning and growth, which might be either aimed at new products for the customer or at process improvement, which would also therefore improve business processes and therefore improve financial perspectives. And so therefore the suggestion was that business should create what were called multi-dimensional performance valuation systems that would put the strategic goals of the business into performance measures for divisional managers. Now, the balanced scorecard is often used as a question in the E3 examination, and it's useful to know some of the things that Kaplan would suggest might be the basis for the measures at the various perspectives. So financial measures, he would say, with things like profitability, the cash position of the company, gross and net margins, and of course the share price of the company on the stock market. The customer perspective might be things like market share, how many customers they're retaining, how many customers they're acquiring, whether customers are happy, and also how profitable a customer is. And that of course reminds us of customer account profitability. Learning and growth could be the level of employee skills and capabilities, the availability of training, how many staff are undertaking training, methods that are used to motivate and develop staff, and also under the same learning and growth, it could be knowledge management and the use of IT systems. Goals for these. Internal business processes, they look a bit like old-fashioned factory measures really, quality, cycle and process time, capacity utilisation, so is the factory fully utilised, half utilised or whatever. Also things like cost measurements would be examples of internal business processes. So Kaplan and Norton's model of the balanced scorecard has become the most famous of the multi-dimensional performance measures. CIMA itself did research into these measures too. And one of the pieces of research they did, so the balanced scorecard is become one of the most famous multi-dimensional performance measures. But it has its benefits and drawbacks. The benefits are that it does communicate strategy better, and it does monitor the factors leading to competitive success, in other words, the lead indicators, and not just the lagging indicator of profit. It also can go below the budget holder, because the problem with conventional performance measures based on money is the only people you can evaluate are people who hold budgets. But if you want to, for example, evaluate the effectiveness of a telesales team, you wouldn't measure it financially because those people haven't got budgets. But you could give customer measures in terms of number of customers they get and extend the control below the managerial level into the operational level, because operational controls are generally speaking non-financial. It does also balance the scorecard. It avoids managers focusing solely upon financial performance in the short run at the expense of the development of customer relationships, learning and growth, or indeed improved business processes. The balanced scorecard is also useful for non-financial observers of the business, in other words, non-financial stakeholders. They too can look at how the business is doing in terms of customer satisfaction. So if I want to go and buy something from a company, I might want to see its customer satisfaction ratings before I buy from it. And the balanced scorecard could be published on its website and allow me to see that. Now, despite its widespread adoption, the balanced scorecard has a number of drawbacks. One is it's an expensive process to run. If we're only measuring profit and profitability, then we have an accounting system in place. If we're measuring innovation and customers, we need to have more data capture, we need to have more measurement taking place. That's going to cost time and money in IT systems. So the costs of control increase, and of course the question is, do the benefits increase correspondingly? It also doesn't give one simple single measure of performance. ROCE is a simple percentage, but managers find themselves being evaluated on several different dimensions, and that can be stressful, particularly if one is improving whilst the other one diminishes. It overloads those managers. They've got to report back at month end now on a series of metrics and not just the usual financial ones. So less time running their business and more time running the numbers. Why are the measures congruent? The chances are the financial measures are developed by accountants, whereas the learning and growth measures are developed by human resource experts, and the marketing department will deliver the customer objectives. Why do we think that they all work toward the same end? Because surely won't HR department measure what's important to it, and finance will measure what's important to it, and possibly the measures might move in different directions, which means the company then fails to maximise anything at all. A more recent argument is that perhaps an organisation should measure more than just its finance, customer, business process, innovation. What about things like the quality of its product? Or, more modernly, corporate social responsibility and sustainability, because those aren't covered in the balanced scorecard. And finally, the measures are developed at a point in time. Now, we know that business strategy is about making companies responsive to change. So the more we've got invested in our control system, the more difficult it's going to be to change behaviour if we need to change the way the business operates. So a balanced scorecard just simply extends the existing business strategy and enshrines it more deeply in the workings of the organisation, and that will make it more difficult to change. Now, another approach that's very popular with CIMA is called the critical success factor and key performance indicator approach. A critical success factor is something that the business must get right for its strategy to succeed. And the way that CIMA sees these follows the work of Johnson & Scholes. They see critical success factors as being places where our company can outperform the rivals. So it might be a better product, faster time to market, and lower cost. They might be our 3 critical success factors. And the secret of this approach is to say, identify what the critical success factors of the business are, and then for each critical success factor, develop one or more key performance indicator that actually measures whether that critical success factor is going to take place. So, for example, if we're saying that customer satisfaction is a critical success factor, that might lead to KPIs to do with customer service time or amount of staff training, or indeed the amount of stock we hold in the warehouse so that customers haven't got to wait too long. And those 3 KPIs can all be related back to the critical success factor of customer satisfaction, and that in turn will deliver our corporate strategy. And CIMA is very fond of setting questions in which you're told, this is the critical success factor, now please develop a KPI that will compel progress towards this and check position as whether it's being done or not. CIMA did a lot of research itself into performance measurement. But before that, the Canadian Institute of Management Accountants, also called CIMA, no longer with us, developed some research using a pair of people called Lynch and Cross, called the Performance Pyramid. And the Performance Pyramid was designed to show how marketing performance measures and management accounting performance measures are essentially congruent. If you look at the diagram, you can see it looks like a pyramid. I'm not quite sure why it's got an eye at the top, presuming that's the corporate vision. But the left-hand side of the pyramid is the marketing aspects of a business, and the right-hand side of the pyramid are the financial aspects. And what it says is, well, strategically, a company is going to have market and financial goals. If we go down to the next level, the managerial level, managers will look at marketing goals in terms of things like customer satisfaction and flexibility to meet the needs of the customer. Now, an accountant is going to look at financial performance and they'll see productivity, but they'll also see flexibility, the ability to increase and reduce output without having large amounts of fixed cost. So the idea of flexible cost structures. And the point that's being made here is that flexibility is a shared goal between marketing, who wants flexible output, and management accountants who want a flexible production technology. At the operational level, marketing will be about the quality of the product and the delivery time of the product, which of course is an aspect of flexibility. The financial goals of the business will be about trying to minimize waste and also to improve the cycle time of products to get more productivity from the factory. But the point being made is that the operational goal of flexibility depends on delivery time and cycle time. Flexibility is something shared between management accountants and marketers, and so therefore so is delivery and cycle time. And the argument goes that the external effectiveness of the organisation, there are certain measures which management accountants and marketers can agree upon, which actually give both external effectiveness and internal efficiency. CIMA's own research was the building block model of Fitzgerald and Moon. This was originally research based upon performance measurement in service industries, as opposed to manufacturing industries, but it can now be generalised. And sometimes it's called the results determinants framework, although CIMA tend to call it the building block model. And the building blocks, as you see here, are three: dimensions, standards and measures. The dimensions are the Fitzgerald and Moon version of the balanced scorecard. The balanced scorecard has got 4 measures, Fitzgerald and Moon have got 6. And their 6 measures are the results of a good performance, which is competitiveness in the marketplace and financial performance, and the determinants of those results, which are things like quality of service, flexibility, resource utilisation and innovation. And what they say is that successful businesses need to have all 6 measures, or should have all 6 perspectives within their measurement system. They also point out for measurement systems to operate properly, they need 2 other things. They need to have some standards by which they work. And this is rather like the SML we talked about earlier, the idea of what do you want performance measures to have. And they say they need to have a sense of ownership, so that the people who are being measured by a performance measure do sense that it is their measure, they believe it's their measure, and they, in a sense, own it and take responsibility to achieve it. The goals should be achievable. They shouldn't be exploitative or impossible to achieve. And they should be fair. And fairness is the idea that they actually are something which the managers, one with another, are being compared fairly. The measures themselves should be clear, they should be controllable, but also motivational, the idea of a stretch target. A target that's too easy to reach, managers don't try very hard. They reach the target very easily. One that's too tough to reach, well, then this one's going to one they won't even try to reach. So rather like Goldilocks and the 3 Bears, not too hard, not too easy, but just right in the middle. A stretch target which brings the best out of management. And really become full circle. From starting talking about accounting measures as control systems of the business, we talked about the financial measures, and now we've come back to the idea that Strategic control is really about controlling the behaviour of managers. And of course, the strategic management accountant is responsible for developing these measures and interpreting them. And really, strategic management accountants are in the game of people management. Thank you.